This video will provide examples of various transactions. In this example, transaction D, the business earns money by selling goods or services to its customers, and this is called revenue. The company NetSolutions received cash of $7,500 for providing services to customers. So right away we know cash was received, and cash is an asset. So record to the cash account under asset for $7,500, an increase of cash. What about the other account? The other account in this transaction is from the selling of service to its customers. NetSolutions called this revenue account fees earned, and fees earned is a type of owner's equity account. Anytime there's fees earned from providing services, it increases ownership, increases owner's equity. In this case, $7,500 is increased. Keep in mind that if the company receives money but have not provided services or have not sold any goods to the customer, then revenue is not yet earned and there's no impact on owner's equity. The recording would go to a different account other than a revenue account. In this transaction, we know fees was earned because service was provided to the customer. The accounting equation balances. Cash and asset increased $7,500, fees earned, an owner's equity account increased $7,500. There are various types of revenue. Costco, besides the selling of goods and services, they have membership fee revenue. Amazon have commission revenue. In this book, revenue from providing services we will refer to as fees earned. Revenue from the sale of merchandise will be called sales. Other examples of revenue include rent revenue, interest revenue. In this chapter, we will soon learn of the asset account, accounts receivable, which is a claim against a customer. Why would the business have a claim against a customer? Because the business have provided goods or services to the customer. However, the customer have not yet paid the company, and so it's a claim against a customer. It's a revenue earned, either sales of a merchandise or fees that's earned but not yet collected because the customer has not yet paid, and the business expects the customer to pay in a future period. So cash from the customer is not recorded in this period. Instead, it will be recorded to accounts receivable. When cash is later collected, accounts receivable would then go down when it's paid off, and cash will be recorded for the collection at that time. In this transaction, November 30th, NetSolutions paid a variety of different expenses: wages, rent, utilities, and miscellaneous expense. It's recorded to each of these respective expense accounts. What is an expense? An expense is the cost of operations that a company incurs to generate revenue. These expenses incurred so that revenue could be generated, right? Because the business needs to incur expense in order to operate, pay for labor, pay for utilities, pay for rent of the facility. Expense is the opposite of fees earned revenue. Fees earned revenue increases owner's equity. It has a positive impact on the operation, on the bottom line of the business income. Expenses, on the other hand, has a negative impact. It decreases the bottom line. Therefore, we see it shown here as a negative number. The negative number here doesn't mean that expenses goes down. It means that it has a negative impact on owner's equity. Just like on the other side, cash is used to pay for these expenses. So cash shows a negative impact on assets. Cash could be in two directions. Inflow of cash received has a positive impact on assets. It increases the assets of the business. Spending of cash outflow would decrease the asset. On the other hand, expenses have only one direction. It has a negative impact on owner's equity. Each transaction involving the expense account would contribute to the negative impact in owner's equity. Transaction F. NetSolutions paid creditors on account $950. NetSolutions had purchased supplies on account before. Therefore, that's why now NetSolutions is paying that creditor on account $950. It's paying off that balance that it owes, the obligation that it had when it purchased on account before. Now it's paying cash to pay off that balance. So cash is reduced $950, and it shows a negative impact on assets. Accounts payable had a balance of $1350. Now it's being reduced by the payment of cash, $950. The recording is to an asset cash account and to the liability accounts payable account. Both $950, both decreased accounting equation balances. The owner decides to withdraw $2,000 from the company for personal use. To record this transaction, two accounts used are cash and drawn. Cash shows a decrease of $2,000. The drawn account is actually an increase of $2,000 because the balance in drawn is now $2,000, but the impact of drawn account on owner's equity is a negative. So we see negative $2,000 under the drawn account as a negative impact on owner's equity, just like cash. With this drawn, cash has a negative impact on assets for $2,000. Drawn account is similar in impact to expense account. As we stated before, expense has only one direction. There's a balance of expense from any transaction involving expense, and there'll be more incurrences of expense, so then the expense account balance would increase, but the impact of the increase in expense is a negative impact on owner's equity. And on here, we show it in terms of the impact on owner's equity. So we show expense as a negative number, just like how drawn is also a negative number.